Okay, good morning and welcome back, everyone, to our Tuesday morning market outlook session. My name is Tony Zhang. I'm the chief strategist here at Options Play. And if we look at kind of where markets stand this week, um, we start off with sentiment slowing quite a bit down compared to what we've seen over the last 4 to 5 weeks. And this is largely around concerns with the valuations that mega cap tech names have continued to trade at. You have the NASDAQ 100 pushing above 27 times forward earnings. You have the S&P 500 approaching 22 times forward earnings. Historically speaking, that's well above the average and really approaching some of the levels that we saw before the dot-com boom. Not quite there yet, but certainly not too far away. And the concentration of technology within the S&P 500 and the NASDAQ 100 have reached levels that have actually beyond what we saw during the dot-com boom. So that type of concentration always brings some risks when there's just a very crowded trade inside of kind of the mega cap tech names. Last week, the biggest concern was around inflation and whether or not we were going to see fewer rate cuts for this year as a result of an uptick in inflation that we saw at the beginning of the week. And we wrapped up the week with kind of a complete 180 after Chairman Powell on Friday at Jackson Hole reiterated, expectations of cutting rates in September and talking about the concerns around the slowdown of the labor market, which suggests that it certainly was more of a dovish tone than he had taken in previous meetings. So that was taken as a positive for markets. But notice this week, despite the positivity that we saw here on Friday, that hasn't really translated into further gains this particular week. And it's really interesting to see that the gains that we've seen over the last week have largely been concentrated in small cap and value versus growth, momentum, and large cap have largely lagged behind and is largely flat here for the week, rather than small caps. Interest rate sensitive sectors such as regional banks, those are the sectors that have really seen the gains on the back of the Jackson Hole speech last week. You have VIX back below 15% as markets shift a bit more to the offensive side versus defensive side in terms of, excuse me, in terms of industries that are outperforming. It's interesting to see on this particular rebound that energy, real estate, and materials are outperforming technology and communications, which are lagging behind. And notably, regional banks, kind of a bit of a bright sector out there at the moment in this kind of marketing, in this environment, that have rallied above kind of all other industries. So, what we're seeing at the moment is some rotation out of the most heavily valued, concentrated sectors within tech, within discretionary, into some of the more value oriented sectors like real estate, energy, materials, those types of names. While on the back end, what we're seeing is that the participation on the rally remains relatively strong. So, this week, kind of the big thing that we're all paying attention to right now is Nvidia. That's reporting tomorrow after the close. And then we have GDP on Thursday, and Friday we'll get the inflation gauge again on Friday. And I actually think that's probably one of the most important measures of inflation that we're going to have to see before the September Federal Reserve meeting. So if you look at the S&P 500, you see that we've continued to just grind higher here to the upside. there's been a bit of a pause here over the last week or so as far as this particular rally. There's a concern that we're going to get a little bit of a pullback here in terms of the equity markets. And it's the same thing here for the NASDAQ 100, which is arguably more concentrated than the S&P 500 in terms of nearly 50% of its weight is in just the top 7 stocks. And that's why, as you can see, the NASDAQ 100 is actually hasn't gotten back up to its all-time highs versus the S&P is still testing those all-time highs. And as you can see, price action today, or sorry, yesterday, is suggesting that there could be a little bit of a further pullback here in the Qs. On the flip side, if you look at IWM, you look at small caps have recently broken out to a new relative high here. We're not too far away from the all-time highs of 242, but we are starting to break out above, call it the 230 double top here, and we'll see if that will hold and continue moving forward. Same thing with RSP, equal weight S&P 500 index. We see the RSP get back to new record highs here. So, the fact that the equal weight S&P 500 is making new highs while the market cap weighted indices are not, speaks to the fact that this is really more of a rotation that we're seeing out of the big tech names into the rest of the market, which is, you could say, healthy for the market. In order to do that, you need to see rotation in order for markets to continue to sustain a continuation higher. So for those reasons, while there may be some short-term concerns about a pullback here, I think long-term, the market conditions that we're seeing here right now are still quite favorable for continuation higher in equities over the long run, especially as you see interest rates decline. That's going to improve margins. That's going to, the tax cuts that recently were just passed are going to start flowing into net margins for the S&P 500. These are all net positives for equities. And that's really where I am currently standing in terms of my outlook from a macro perspective. And that is reflective in the trade ideas that we are showing you here today. We have quite a few to go over, so let's jump right into it. The first one I want to show you is Trust Financial. This is one that is not on everyone's radar, but we actually saw quite a few of these regional banks generate buy signals here over the weekend. And Trust Financial, as you can see, recently just broke out here above, call it the $45 level here. And you can call it a triple top if you want to. 1, 2, 3 triple top that we recently just broke out here above on that on Friday, and yesterday's price action held that specific level. So we're looking for some further upside here. Out of all of the regional banks, Trust is definitely the one that's trading at the most reasonable valuation at 1 time book value, which is a nearly 25% discount to 20% discount to the industry, even though they're expected to grow faster and they are more profitable than their peers, equally as profitable and equally efficient as their peers, but it's expected to grow faster. So the fact that it trades at a discount relative to its peers is what makes Trust Financial a relatively attractive name in the moment in terms of looking for opportunities within regional banks. And our upside target here would be $50 initially to the upside, and we're looking for some further upside beyond that if we can get to that $50 level. The next one I want to take a look at here is Copart. Again, not a household name. Most of you are probably not familiar with this particular name. But as you can see, recently, this is a stock that has started to make some moves. There are a few different ways that you can draw your lines, but essentially what we're seeing is a bit of a bottoming formation that's starting to improve here to the upside. You can also draw your lines this way, where we've had this kind of bearish trend line that's recently broken here to the upside, and you can draw one last line here at around $50 that it hasn't cracked yet, that perhaps you'd like to see a breakout here above that level to target in the low 60s here to the upside. So the upside opportunity is quite large here. And as you can see, the trends, which have been bearish for quite some time recently in the last week or so, have recently just turned green. Now, Copart, they operate vehicle salvage auctions globally. Essentially, what that means is that if you total your car and your insurance company is trying to write it off, they will effectively buy the scraps of your car, salvage it, and then sell it for parts. That's what they do. It's um, not a particularly sexy industry, but one that is important. And Copart trades at a premium relative to its peers. It trades at 28 times forward earnings, but it's expected to grow top and bottom line just around 10, 11%, which is respectable. But what I think is really interesting about this particular company is that net margins are north of 32%. So for every $1 they generate in revenue, they earn 32 cents in net profits. Very few companies are that particular efficient at generating profits, and they are one of them. And I think that is partially what justifies, the 28 times forward earnings, which is certainly not on the cheap end of the curve when it comes to valuations. But when you look at the technicals, you look at the fundamentals, it looks like things are starting to turn around a little bit, and that's where I think Copart is an interesting opportunity at the moment. The next one I'm going to take a look at here is PLD, Prologis. They operate one of the largest warehousing REITs in the world. So if you think about Amazon, when they're looking to launch a new location and they need warehouses in wherever they're trying to launch a new market, Prologis is likely one of the real estate managers of their warehousing logistics facilities globally. They operate something like 1.3 billion square feet of logistics warehouses globally, and they are by far the largest in this particular space. They're trading at 21 times funds from operations. So that's a different metric that we use for REITs versus forward earnings. And if you look at Prologis, what's interesting about them is that, they're expected to grow faster than the industry, but net margins are north of 40%. So incredibly efficient at generating generating profit from revenue. And that's why, even though it's trading at a premium relative to its peers, I think that there's some potential upside here. And as you can see, this stock is kind of trading sideways here for the last nearly, almost a year now. So basically, we started back here about 6 months now. We've been trading sideways. It has been trading, sideways for nearly a year now as well. But it's been pretty choppy within that, as high as 120, 123, as low as 85. But recently, as you can see, this sort of formation is starting to break out to the upside above this 110 level here. So this is what I'm looking for, is a bit of a constructive move here above 110. And that's what makes the timing on this look quite attractive. Okay. The next one I'm going to take a look at here is MasterCard. Now, we have liked Visa in the past, but MasterCard is certainly setting up currently for a interesting setup here. Basically, we've reached a new 52-week high, or I believe it's a new record high, actually. So we kind of just broke out here above this, you could call it a double top here, around this 595, 600 level here. We're breaking out above that to a new all-time high. And MasterCard, similar to some of the other names, trades at a premium relative to its peers. It's trading around 37 times forward earnings, which is not cheap. But look at growth expectations. We're looking at EPS growth at about 15%, revenue growth around 13%. That is more significantly higher than the average S&P 500 stock. But what excels a lot for a lot of these credit card companies, specifically Visa and MasterCard, is that net margins on MasterCard are 45%. So for every $1 they generate in revenue, they generate 45 cents in net profit. So a huge amount of free cash flow that they generate, and that is largely the biggest input when we look at valuations. And MasterCard trading at a high valuation is justified given just how efficient they are at turning revenue into profits in their bottom line. Then we'll take a look at a couple of the I think healthcare stocks that recently started to break down. Break out. If you looked at Becton Dickinson, they are a medical equipment manufacturer, recently breaking out here above this, call it the 185 level here. We broke out here to the upside. It recently just shy of filling that gap. So we're looking for at the least filling that gap and then potentially going further to the upside. Now, BDX trades at a very reasonable 13 times forward earnings. It's not as profitable as its peers, and it doesn't grow as fast as its peers, but it's trading at a valuation that's about half of what their peers are trading at. So for those reasons, I think it's worth paying attention to, just given the fact that there are so few stocks trading at 13 times forward earnings that from a charting perspective, looks like investors are starting to pay attention, and there is potentially some institutional accumulation of this stock recently based on the relative strength that we've seen on this particular stock over the last few weeks. Another one in the medical space is Merck's pharmaceutical company. Merck's similar to some of the other names that similar to some of the other names that I've shown you here. As you can see, recently kind of completed a bit of a bottoming formation and recently just broke out. It's coming to retest this level of support, and we'll see if that can continue moving higher here to the upside. Merck's, like some of the other names that in the healthcare space, trading under 10 times forward earnings. That's what makes kind of a lot of the healthcare names, especially the value-based names, look so attractive. They're just trading at valuations that are so low that the risk of the downside is much lower. You're expecting EPS and revenue growth that is, either in line or exceeds the industry. And Merck's actually is far more profitable than its peers. Its net margins are approaching 26% versus most of its peers around 16%. So for those reasons, the fact that they're fairly efficient at operating their company and generating free cash flow, I think Merck's trading at under 10 times forward earnings is significantly undervalued and presents significant upside opportunities in the healthcare space. In the call it technology or financial technology space, XYZ Block. We've liked this stock basically since it broke out here above the $63 level. The stock has kind of traded higher, traded lower, and now it's trading back up towards that $80. You can call it a bit of a double top here, and we'll see if we can break out above that. Our upside target here for Block is $85. So we're getting very close to that upside target. And we'll see once we get to that upside target if we can get, back into the low 90s, 95 range here, which is where it was trading before the stock kind of broke down earlier this year. So, Block trading at 17 times forward earnings is also quite inexpensive, especially if you look at kind of growth expectations that exceed the industry, net margins that exceed the industry, not by much, but it's certainly still higher than the industry average. And for those reasons, I think the fact that it trades at such a substantial discount relative to its peers, that's what represents the upside opportunity here for XYZ Block. Alphabet. We have been bullish on Alphabet here since the pullback here back in June. We saw this particular pullback as an opportunity to get long. And now, as you can see, what's really interesting is that Alphabet on yesterday's move made a new all-time high. Alphabet trades at, despite all of this, only trades at around a shy of 21 times forward earnings. Now, this is because of antitrust issues, regulatory issues, concerns around profit potential for Alphabet. Um, but if you look at kind of all the other names in this particular space, especially ones that are competing on from an AI perspective, they're all trading at valuations that are significantly higher than Alphabet. Yet I think Alphabet actually has one of the more robust AI models and has arguably one of the best distribution models for that AI for their users compared to some of the other companies. So I think for that reason, for those reasons, I think Alphabet trading at around 20 times forward earnings is probably one of the most undervalued technology plays at the moment. Compare that to Apple or Nvidia or Microsoft or Oracle. These are all companies trading north of high 20s, high 30s in terms of forward PE ratio, and that's really where, in my opinion, there are some substantial risks to those types of valuations that those mega cap tech names are trading at versus something like Alphabet trading at a much more reasonable growth expectation much more reasonable valuation while maintaining growth expectations that are largely in line, if not exceeds the its peers. And lastly, what I'll leave you with is a couple of ones is Micron. Now, Micron is going to be very heavily skewed or tied to NVIDIA earnings tomorrow. So this is one to watch here. There's definitely some concern that NVIDIA markets are getting a little bit too stretched, trading at 40 times forward earnings. At this stage, they really have to continue to perfect both earnings and revenue, but also providing guidance that is, call it, significantly stronger than what the market is currently expecting. There's a lot of interest in terms of whether or not NVIDIA is continuing to sell GPU chips at the same pace that they have seen over the last few years, whether that demand is still completely insatiable or there is some potential slowdown of NVIDIA chips, because the stock is trading at 40 times forward earnings for a hardware stock is effectively priced to perfection. It's hard to see how they can beat and continue to move much higher from where they are versus the risk of any form of a slowdown, any concerns around just any concerns around the market could send stocks like Nvidia down significantly here. So going into earnings, this is definitely one that I'm more cautious on this particular earnings season versus the last few earnings seasons for Nvidia. And then what I'll do is I'll leave you with a couple of bearish ideas. The first one I want to show you is Philip Morris. Philip Morris, as you can see, recently broke down here below the 175 level here. The breakdown here came back to retest this level of support, and now you get that retest that level of resistance, and now it's got rejected, and now you have confirmation of that particular move here to the downside. So Philip Morris trading at 22, 23 times forward earnings is much more expensive than its peers. And it's not as profitable. This is really what Philip Morris has struggled with over the last few years is maintaining their margins. They have not been able to maintain their margins. So net margins now are around 21% versus, is in the close to the 30% level here just a few years ago. So for those reasons, Philip Morris is on our bearish list here at the moment. And then lastly, we have one more bearish name, which is Cintas. They are a supplier of workplace uniforms, also not particularly sexy, but trades at 44 times forward earnings. So when you have a stock that's trading at 44 times forward earnings, that's not a particularly scalable business. It's not like running servers that you can just build a piece of intellectual technology and sell that same technology to lots of different people. When you're dealing with uniforms, they're just not as scalable, and trading at 44 times forward earnings is just difficult to wrap your head around, especially if you look at Net margins. Yes, they are high relative to their industry, but 17% net margins, is not significantly higher than the average S&P 500 stock, which is around 13% net margins. So it's not that much more profitable, in my opinion, to justify, the high valuation that it's trading at right now, and that's why we maintain a bearish view here on Cintas. So with that, that covers what I wanted to share with you here today. I hope that this is helpful in giving you a better understanding of how we're viewing the bigger picture and, more importantly, some of the ideas that you can trade here for this week on the back of that. With that, thank you so much. I hope you guys have a great trading day, and I'll see you guys here next time.